But backwardation in both gold and silver is flippin' scary for LBMA or the COMEX or any entity that must deliver out that physical gold and silver, because it's very, very hard to come by the physical market, especially in the US, which is primarily a paper contract market. Don't be fooled. Take advantage of it, but don't be fooled, because they want you to stay away from it.
Something huge just happened in the silver market, and this time, it's not a rumor or a short-term spike. For the first time in decades, both gold and silver are in backwardation, meaning the spot price is now higher than the futures price. That's the market's way of screaming that physical metal is running short, and that the paper system controlling it may finally be breaking down. Gold now trades around $4,003.58, and silver near $48.87, while COMEX and LBMA scramble to meet physical deliveries. Analysts are calling this the deepest disconnect between paper and physical markets since 1980. Confidence in the old system is collapsing, and the cracks are showing in real time. And now, Lynette Zang is warning that this is the moment she's talked about for years, the start of the final meltup phase, the last surge before a full monetary reset. This interview was recorded on October 29, 2025, on Zang Enterprises with Lynette Zang. If you want to listen to the full discussion, the link is in the description below.
So this is really what's happening with spot silver. Now, backwardation, this is true for both gold and silver, but is when the current spot price is higher than the futures price. So buying silver out in the future, because what's been happening with extreme demand is that people don't trust those future promises, and you shouldn't. We've had some entities, some large entities that usually, contracts for silver are like 5,000 ounces. They have different size contracts and they're making them smaller and smaller so you guys can participate. That's just a contract. It doesn't mean anything. And a lot of what's happening, and I think I saw it this morning, so I stuck a slide in there, so I'm probably going to be a little redundant on this. But in the ETFs, so SLV, GLD, have seen the largest outflow in a long time. So they saw this massive inflow pushing the price up. Now they take it out. That pushes the visible price down. But what's changed? What changed from a week ago? Absolutely nothing, other than those that would have to deliver out the silver are scared because they know that the emperor has no clothes. They know that when push comes to shove, if they are forced to deliver out silver or gold, that they cannot do, because in the physical world there's a finite amount, then you're going to know that the emperor has no clothes. And they don't want you to know that, because they want to keep this game going and stay in power. And so you'll see something kind of similar with gold, but remember that spot silver had a much more stretched run. So as you can see, when you're looking at this chart, it is still, the spot silver market is still 22% away from that 200-day moving average. So if 10% away is considered a lot, then 22% would be extreme. It doesn't mean that it can't go back to extreme levels, right? Because we're seeing the same thing in all of the markets. Why? Maybe we're in the melt-up phase that I've been talking about, which is the last phase before the crash. I will do a piece on that so you can see it and what it looked like in different countries. That's coming up, and I will be working on it. That's going to take me a minute. Second question down the list is, could you please also talk about the crash in silver? So today I'm going to talk about both of what's happening, because we aren't talking about, and we're going to talk about this too. I'm going to show you this too. We're not talking about the physical markets. We are talking about the spot markets. But of course, you have been trained to think that that's representative of gold and silver, when in reality, it is simply a trading product that is designed for perception management. That means that they want to make sure that you don't own physical metals, because after all, they need your wealth in the system, because then it's much easier to inflate away. This stuff, physical in your possession, runs zero counterparty risk and also runs zero inflation risk. They cannot inflate this away, and it's not because I or anybody else says so. That's because they are both used in every single sector of the global economy. So that means that you have full functionality and full demand. So let's just go to the charts, and I'm going to start with a long-term chart, because while we've talked about this in the past, I want to make sure that you understand it. And there is this blue line that runs underneath all of these choppy lines, and that would be the 200-day moving average. So what that means is every day for 200 days, they total up where spot silver or spot gold or this is true for anything on Wall Street. Wherever the price closed, they total it up for 200 days, they divide it by 200, and it gives you an average. And that 200-day moving average, I've told you this before, but it acts like a rudder on a ship, so that there's only so far above or below that average that it can go before it always comes back to that average.
Lynette Zang doesn't mince words. Backwardation in both gold and silver is terrifying for the exchanges that rely on endless paper contracts. When today's spot price exceeds the future price, it means people no longer trust promises of future delivery. They want their metal now. She explains how this dynamic exposes a fatal flaw in the system. The U.S. market is primarily a paper-based market, a place where contracts, not bars, change hands. But the moment delivery is required, the illusion vanishes. If the COMEX or LBMA were forced to deliver on every outstanding contract, the vaults would be empty in days. That's why, she says, insiders are scared. Zang points out something few mainstream analysts discuss: massive outflows from the SLV and GLD ETFs. Billions of dollars in gold and silver have been quietly pulled from those funds, supposedly to rebalance portfolios. But she believes it's a coordinated move by institutions securing physical metal before prices explode. The irony is that ETF redemptions temporarily push spot prices down, tricking retail investors into thinking demand is falling. In reality, the metal is simply leaving the system permanently. From a technical standpoint, silver remains 22% above its 200-day moving average, an extreme level of stretch that historically marks the final acceleration before a correction or a complete price repricing. Zang calls this the meltup zone, the euphoric final stage before markets snap. She says this isn't just another bull run, it's a reflection of a dying currency system. And while mainstream commentators focus on paper charts, Zang reminds her audience of the real foundation. Physical metals carry zero counterparty risk and zero inflation risk. You can't print them, fake them, or inflate them away. They're essential to every industrial process, from semiconductors and energy storage to defense manufacturing, which guarantees real, long-term demand. Her advice to investors is straightforward and defiant. Don't be fooled by paper volatility. Every correction is an opportunity. Hold your metal in physical form, not as digital or ETF exposure. Focus on weight over shine. Bars, rounds, coins, whatever you can hold, not trade. She calls silver her barterable position. For her, it's not about collectibles or numismatics. It's about having something tangible when the system resets. And according to her, the true monetary value of silver, once measured against global money supply and real purchasing power, could eventually reach $2,000 per ounce when the paper game finally collapses.
So here are just some examples on this long-term chart. This is a silver. Happens to be a silver chart. Okay. Now you can see where all of these go. Whoops, let me back up. I did that way too fast. Sorry about that. Okay, so you see where these boxes are? Can you see how extreme So you can see where these boxes are, and if you can see that blue line, there's only so far above or below that it goes before it comes back to that line, back and forth. Now, 10% away from that line is already considered a lot. So we have to keep that in mind as we move forward. But can you see what I'm talking about? And with the correction, in other words, the spot price of silver coming back down, well, there's always, I've talked about support and resistance, right? So here's how that works, right? Let's say support, and you were going to buy something, like you were going to buy spot silver when it was $36 an ounce, and you didn't do it. And then it shot all the way up past 50. Well, you're going, man, if it ever gets that low again, I'm going to buy it, right? So that creates a pool of buyers at that level. And so spot goes down, dips into that pool. There are more buyers. It pushes the price up. Spot goes down, dips into that pool. It needs to use up that pool of buyers before it can go to the downside. And the reverse is true on the top, and that's called resistance. So let's say you were going to sell it at over 50. And remember, 50 was the very long-term peak in that triple cup formation on the long-term spot silver chart. I've shown you that a gazillion times. I'll show it to you another gazillion. But that creates a pool of sellers up at that higher level. So spot goes in, dips into that pool of sellers, that pushes the price down, which is what we're seeing. That's one of the things that we're seeing right now. It goes up, it dips into that pool. When it uses up that pool of sellers, that's when it can break free and go to the other side. So we could potentially be testing that silver contract at that support level, and we'll get into it. I'm going to go to a closer chart right now. This is a 1-year chart, and you can see in this case that red line. Let's see, this is spot silver. Okay, you can see that red line is the 200-day moving average. That blue line is the 50-day moving average. When the spot price is above that 200-day moving average and the 50-day moving average, that is very, very bullish. But can you see how far stretched the spot market was from that 200-day moving average? And even going back through last night, because these graphs are from yesterday, right? I wanted to be as current as possible to show you this. It's still 22% above that 200-day moving average. So I frankly, knowing that this is a trading instrument and that it does not represent the true fundamental value of an ounce of silver, which is somewhere around $2,000, this is an opportunity to get in. Because with silver, for me personally, and you have to do whatever you're comfortable with, so I can just speak for myself. But for me personally, silver is my barterable position. So I don't really do collectible silver. I'm just looking for a variety of sizes. And in this case, I don't care if it's new. I don't care if it's old. I only really kind of care about the weight. And beyond that, it could be in any form, absolutely any form. Silver and gold at its base is monetary. So it's important to understand that. But can you see how far away we still are from that 200-day moving average? So if it corrects back down to that, if it even goes below it, I'm okay, because look at the direction of the 50-day as well as the 200-day moving average. They're in an upward trajectory, right? So remember, there's only so far above or below that it can go before it comes back to that average. So understanding the direction of that average is also really important to take note of. So if you're not clear on this, when we go to the Q&A part of it, I can pull these charts back up and we can look at them even more closely.
So what happens next? Will silver and gold correct back to their long-term averages, or are we watching the beginning of a permanent break between paper and physical markets? Q. If every silver contract on the COMEX demanded delivery today, could they actually deliver? A. Lynette Zang says no way, and that's when the entire paper illusion unravels. When trust in promises dies, only what's real survives. What do you think? Are we entering silver's final melt-up, or can the paper system still fight back a little longer? Share your view in the comments below. And if you want to stay ahead of what's really happening in gold, silver, and the global monetary system, make sure you subscribe to Macro Edge, hit the bell icon, and join the community that looks beyond the headlines to understand the real power shift underway. Because the paper world may be cracking, but those who hold real metal hold the future.